y contentos de estar con ustedes. Yo les recuerdo, estamos en el ciclo de conferencias del Centro de Estudios China-México de la Facultad de Economía de la Universidad Nacional Autónoma de México, UNAM, organizados conjuntamente entre la doctora Yolanda Trápaga y yo. Los invitamos, por cierto, a revisar. Llevamos ya más de 300 conferencias sobre temas muy diversos. Encontrarán en el portal del CECHIMEX las conferencias, los PowerPoints, entre otras cosas, ¿no? Dos o tres antes de darle la palabra al doctor Kaplan. Por un lado, nos vamos acercando. Yo les recuerdo a todos los que estuvieran interesados en temas de China, el próximo año será el sexto la sexta conferencia internacional de la Red Académica de América Latina y el Caribe sobre China, ¿no? Esta va a ser a finales de mayo. Los trabajos, las propuestas las estamos solicitando. Va a haber un proceso de selección a mediados de enero. Entonces, ojalá que algunos de ustedes estuvieran interesados, ¿no? Y después otro anuncio. Terminamos la semana pasada el monitor de la infraestructura china en América Latina y el Caribe, y hace un par de semanas antes entregamos el monitor de la inversión extranjera directa UOF de China en América Latina. Entonces, con eso terminamos este ciclo de renovación de la información y actualización de la información. Lo ponemos a su disposición. Yo les recuerdo el banco de datos, los textos en inglés, en español y en chino están a su disposición, ¿no? Entonces, el día de hoy, pues muy contentos de contar con Stefan Kaplan, con nosotros. Muy amablemente accedió a participar. Yo les recuerdo, Stefan es profesor asociado de Ciencias Políticas y Relaciones Internacionales de la George Washington University. Está asociado a un grupo de centros de investigación y se podrán imaginar, bueno, pues nos interesa mucho su trabajo que ha venido realizando en los últimos años sobre temas de finanzas globales, inversiones chinas, en países en vías de desarrollo, también en América Latina, y la presentación de hoy pues está estrechamente vinculada a su última publicación, que se llama Globalizing Patient Capital and the Political Economy of Chinese Finance in the Americas, ¿no? Que se publicó en 2021. Entonces, we are very grateful, Stephen, for your time, for your patience, and you are very welcome. And again, as we mentioned, so it would be great if you could do a presentation of around 30 to 45 minutes, and so that we have time for questions that we will do through the chat. And again, I would be very happy to assist you if you cannot do both at the same time, no?
Well, thank you very much for having me. Muchas gracias por la invitación. Estoy entusiasmado para compartir mi trabajo con ustedes. The name of my work and my book that was just released, as Enrique was mentioning, is called Globalizing Patient Capital, the Political Economy of Chinese Finance in the Americas. I will be presenting on the book today, and I look forward very much to your comments and questions. A nice place to start when I introduce this work is just looking at China as a global creditor compared to other countries that have historically been global creditors, right? So in this graph, this data comes from the BIS, and we're looking at countries like Germany, the United States, and United Kingdom. And you could see since 2008, the global financial crisis, we see China has really emerged as a global creditor, right? And today, if you track sort of this line since 2008 with China on it, we see now today that China is a top 5 banking creditor globally. And why this is important is, of course, China is official creditor. And then we could think about, okay, compared to World Bank, IMF, other official creditors, if now we have sort of a major bilateral official creditor that's one of the top bankers in the world, how does this affect what we know about creditors and debtors, right? So that's really kind of one of the key puzzles that motivates this research, right? Is China any different than other creditors? If so, why? And how does that impact on the borrowing side, countries within Latin America and more broadly, the developing world? So, of course, at the last, we have China's 20th National Communist Party Congress coming up this October. Of course, at the last one, at the 19th Congress, we had President Xi making bold proclamations about becoming a leading power by 2050. And not only becoming a leading power, but blazing a new trail for other developing countries to achieve modernization. China, right, according to Xi, offers a new option for other countries who want to speed up their development while preserving their independence. So certainly President Xi putting forth at the National Congress and beyond this idea of not only is China a major global creditor, striving to be a major power, but also, hey, we're going to have a different approach than others, right? So part of my work is looking at, from a banking creditor perspective, how different is China's approach and what are the implications? Now, before we do that, we can look at China's lending, right, their policy bank loans, from the perspective of the borrower, right? What does China's portfolio look like? Now, this data before you, I've aggregated from China Development Bank and Export-Import Bank of China. This comes from their annual balance sheets. This is calculated based upon data in 2017 and 2018. And what you see here at that point, right, of course, Asia Pacific is making up a big chunk of those loans, not surprisingly, that being sort of the initial thrust of the Belt and Road Initiative, even though the Belt and Road Initiative today, their chief foreign policy infrastructure program is much wider, right? You can see sort of the concentration on Asia Pacific, but you can also see that the Americas, in addition to sub-Saharan Africa, are some of the recipients that have the most loans, right, outstanding to China, right? So that makes what's happening in the Americas really important, not only from a Latin American standpoint, but also solving this question of, is China any different? And if so, how is that affecting developing countries, right? So the Americas are right in the middle of that puzzle. Now, my work from a theoretical perspective is embedded in what's known as the Mundell-Fleming trilemma, right? And it comes back to questions I've asked in previous rounds of work that deal with austerity. And it has to do with, okay, how much room do countries have to maneuver? Now, what we know, right, from the classic Mundell-Fleming trilemma is once you have a world with capital mobility, right, capital's free flowing across borders, governments generally face a trade-off between macro policy autonomy and exchange rate stability, right? But a key assumption of this literature is that capital tends to be private and is prone to exit. So when there's financial instability or currency depreciation that might erode profits, we see that capital has a tendency to move out of the country, right? Or if not move out, the capital exit threat itself can compel higher interest rates, constrain fiscal expenditures, all intended to re-attract this investment, right? But the premise is, right, that this is private sector short-term type of investment. What do we know about China's investment internationally? It's a bit different, right? Hence the term patient capital, because it's state-led capital and tends to be longer term, right? What we know of China's kind of global capital is it has capital controls that limit overseas private investment, restricts the ability of residents to invest in financial assets overseas. So there are minimal short-run financial connections between China and the rest of the world. So it tends to be this long-run financing that is key. And I make an argument in terms of the trilemma then that this mitigates the capital exit threat, right? That there's going to be a longer-term horizon. If the lesson from my previous book and the lesson for people who've studied, previous crises in Latin America through the 80s and 90s is oftentimes Latin America has a very long-term development trajectory, but is financing itself with very short-term finance, right? And has created a lot of problems over time. The argument, right, would be that, well, China has this longer-term financing that changes sort of that mismatch a bit, right? We could have a debate about whether Chinese financing is good or bad for development, but what's clear is there's a longer-term horizon, right? And so that's significant in itself and significant enough to change some of this trilemma or some of these trade-offs. So we have this long-term maturity structure. The first question, okay, how does it compare to other creditors? Well, one reason that China gets so much attention is just it's unique because of the size, the scale, right? You may have other bilateral creditors in the world, but no one who's on the same scale today as China. There's also, in terms of the maturity of Chinese loans, average maturity is about 17 years. When we think of private creditors, right, generally you're talking about horizons are closer on average to 5 years or so. We also see that this long-term maturity structure reflects infrastructure, right? A lot of what China is doing internationally is financing of infrastructure. So that's long-term, and by the nature of infrastructure, right, it's gonna, come in many tranches over a long term, right? Sometimes in the case, for example, of Argentina, we see headline numbers, $2-3 billion going into hydroelectric plants in South America, but in reality, right, it's being released in tranches over the course of several years. And so generally those tranches are $100 million here, $100 million here, right? So there's kind of a very long-term maturity structure. So that's one clear aspect that's a bit different. Another aspect, I argue, is higher risk tolerance, right? So Chinese policy banks are more likely to stay with their investments in good and bad times, right? It doesn't necessarily mean, right, that there's unlimited patience, but it does mean, right, that even if we think of how Chinese banks act domestically, they tend to take evergreening strategies, right? Or essentially waiting for better times. They'll roll over loans, right? Restructure loans, not necessarily forgive principal payments, but try to extend maturities, extend some of the terms of those loans over a longer horizon and through bad times, right? So generally, another characteristic is this higher risk tolerance. It's also sort of what we've seen from that shorter term capital exit threat I mentioned with Mundell-Fleming trilemma is private capital tends to move out during downturns. What we've seen over the course of the last decade or two is when there's actually downturns, Chinese investment comes in, occasionally trying to get cheap assets, improve market share, right? Improve the competitiveness of firms internationally by improving logistical skills, marketing, distribution. So we see very much kind of a different strategy that this finance is even supporting at times, right? A longer term, kind of more risk tolerant strategy. Why? Well, my argument too is that China is kind of using its financing as a way to break into new markets, right? So if we think of the World Bank and how does the World Bank decide what projects to invest in? Well, often, even though it's official credit, it's still thinking, okay, how profitable is this project or that project, right? Comparatively, China is often, right, particularly as they're breaking in new markets, viewing it as what I call market maximization instead, right? Willing to subsidize riskier credit investments to grow commercial and market share over a longer period of time. Again, this risk appetite is not limitless, right? We've seen this in the case of Venezuela, Pakistan. They're quite willing to eventually unwind, right, some of this exposure, but generally they do it in terms of not extending new loans, rather than necessarily just writing off debt, right? They're even when there's restructuring, they're very patient in terms of that restructuring too. And here you could see, right, from a data perspective, just the kind of, this is with FDI rather than financing, but this kind of trend that tends to happen where you get a global financial crisis, Brazil's economic crisis, Brazil's political scandals, and instead of like FDI leaving the country, right, we instead see a pickup, right? Mergers and acquisitions and things along these lines during downturns. And ultimately, the bank finance that's going internationally is trying to support sectors. So the last feature, so far I've mentioned longer term horizon, higher risk tolerance, as two ways that China's finance differ from traditional Western creditors. But there's also obviously conditionality, right? There's a lack of policy conditionality. In other words, what we've seen historically, where we've had IMF and World Bank loans or even private sector loans to countries, there's a big focus on what policy is accompanying that. What is your macroeconomic policies? So we get things like budget discipline, right? Targets, fiscal targets, as metrics of whether or not loans should be continued to be extended to countries or not. Comparatively, in China, we have an official doctrine of non-intervention in domestic affairs under the 5 principles of peaceful coexistence. This also overlaps with the general, right, developing country dedication to non-intervention that goes back to 1954 in the Badang Conference, right, where, okay, there's kind of more skepticism of this kind of intervention, right? And so that being said, right, so maybe with Chinese loans, you don't have this policy conditionality, but what I argue is you get a different kind of conditionality, right? So the first idea, the concept that I introduced from the book, in addition to patient capital, was that Chinese banks are trying to maximize markets, right? They have cheap or below market financing to try to break into new markets and improve their commercial share, their market share internationally. But the other thing that's happening is that instead of policy conditionality, given this goal of market maximization, we get what I call commercial conditionality, right? And so effectively, this financing is not, you could look at financing that comes from the World Bank or IMF, policy conditionality is a way of making sure, governments, stay within their means or are able to repay their debt. China doesn't do this. So it's a question of how do they mitigate risk? Well, what I argue is commercial conditionality has 2 features, right? On one hand, commercial conditionality is oriented towards, as we'll see in a moment, mitigating financial risk. How? By using commodities and land as collateral. But it also is essentially subsidizing commercial activity internationally to try to maximize markets, right? So when we're thinking of what's the trade-off for Chinese lending, right? You get this cheap infrastructure financing, but the trade-off, the fine print, is much more oriented towards commodities, future commodity deliveries, guaranteed contracts with Chinese firms, contractors and suppliers, commitments to buy Chinese machinery. So in this way, right, when we think of what are the strings attached to Chinese loans, it's a lot more like tied aid. It's a lot more like a trade deal where Latin American countries and governments need to be very concerned about, okay, how do we promote our own local content, right? Because China's going to these deals trying to promote Chinese content to the maximum possible in many cases. So here's another sort of graph here that's looking at the growth of Chinese finance over time. I made an argument earlier that instead of private capital, now that we have sort of the state-led capital from Chinese policy banks, it may change countries' room to maneuver. What you can see here is the growth since 2008 in Chinese policy bank loans as a share of GDP. You can see that compared to other official lenders, multilateral loans, is this dotted line here, there's been tremendous growth in these policy bank loans. So it's now accounting for one of the major types of financing for some big borrowers from Latin America. Of course, bond financing is still very key for several countries, but we're seeing that more and more countries over this period in time are also using policy bank loans. And so ultimately, my argument rests upon, as countries fund themselves with more policy bank loans, this could change sort of their room to maneuver. Now, of course, the channel is going to matter. So not every loan that is going right to Latin America is going directly to a state, right? We have loans set up in the cases of Venezuela or Ecuador where they're more state to state, and there's more sort of direct allocation of funds to a government development fund or things along these lines. Comparatively, we also get loans that are just market oriented, right? That they're going directly into corporations instead. So my argument is going to revolve around more of these state-to-state loans. And as you can see here, these state-to-state loans, particularly in terms of loans outstanding, still account for a large share of these loans outstanding to Latin America. Now, the investment channel, why would this matter, right? Well, let's take two examples, in this case from Argentina. They have hydropower stations that reflect more of this state-to-state channel. So the project terms come from direct contracting with Chinese banks, right? And Argentina can go directly to contract with Chinese banks rather than bidding if it's concessional, right? Under Article 5 of Law 27. Now, Argentina has to provide a state guarantee for the loan, right? So there's automatically sort of a guarantee, an implicit, right, increase in Argentina's indebtedness. For example, if for some reason this loan is failed to make payment on, the Argentine government will support it. But we also see that some of the attachments or the commercial conditions reflect 23% of the loan is paid for Chinese machinery and equipment, right? So this part of the loan never goes to, anybody in the state necessarily, but directly to Chinese corporations to pay for machinery, equipment, turbines that's needed for these projects. But 77% of this loan is still going to the fungible civil works projects that are oriented around this loan. And there we still have some spending discretion possibly. We also have a difference in terms of transparency in that it's very hard to tell what's in these contracts, right? And there was a lot of concerns in Argentina with these hydropower stations, well, that they weren't as environmentally sound as they could be. And when Macri became president, there was actually the Supreme Court suspended this construction in a legal ruling because of these environmental concerns. And this led to an eventual reduction in the number of turbines and generating capacity. But the argument is essentially, right, state to state, you'll get direct contracting, you might get higher indebtedness, but you also get some of this fungibility and a lack of transparency in many cases. Now, when it instead flows the private procurement channel, the loans look a bit different, right? And this is a good example of Argentina's solar parks, right? Here you have a privately managed auction system called Renovar, and you have a company like Shanghai Electric Power Construction winning the bid for $390 million, right? However, the loan now flows directly to this corporate enterprise, right? Once it wins the bid, not through the Argentine government. So there's not really any room for discretion here. And you also get still this commercial conditionality, right? That doesn't go away. You get China Exim Bank's preferential export buyer's credit, which is directed precisely towards Chinese machinery and equipment. So commercial conditionality stays. One big difference, as we see later, is when it's state to state. I also make the argument that China's hedging risk with this commercial conditionality, right? And that's when we get oil for loan contracts, right? Commodity guarantees, things along these lines. Another difference with the private procurement channel, is that there's more transparency often, right? Often there's local community consent. There's even training that's promised for plant construction and operations. There's ways to participate, workers participate in the province according to provincial law 5915, right? So the structure, depending on whether it's state to state versus private procurement, right? The characteristics can change quite a bit. So when we're talking about government discretion, I'm mainly focused on these state-to-state loans. And the argument would be, right, when you get state-to-state loans coming in, as it grows as a share of government's total public financing, you're likely to get it correlated with larger deficits. So we see, right, when China doesn't have much bilateral credit flowing to a country, less than 5%, well, we actually can continue to see budgetary surpluses in general. But as that amount of Chinese bilateral credit grows, that blue line or blue chart grows over time, we should see higher and higher primary budget deficits, or countries have more room to maneuver. So looking at some statistical regressions, right, you see some similarities in terms of these arguments that I'm making with finance, right? When you have countries borrowing in bonds or borrowing multilateral loans, we tend to see, right, this tendency towards budget discipline or austerity as shown by the positive, right, correlation here, meaning when countries have a greater share of their of their debt outstanding in bonds or loans, you're more likely to get budget surpluses. Comparatively, you can see the negative coefficient with China's state-to-state lending, and this tends to correlate with greater budget deficits over time. So it does indeed look like countries are getting greater degrees of maneuverability. You see it here in these figures too, that this tends to hold, right? These negative coefficients hold across many different models over time. Another way of looking at this is just purely descriptively as well. Here we have Chinese state-to-state loans and Latin American fiscal policies, specifically focusing on Argentina, Ecuador, and Venezuela. Why? And over the years of 2000 to 2018. Well, Argentina, Ecuador, and Venezuela have left of center governments during much of this period of time. So you would expect those left of center governments to be spending more. But before Chinese financing enters the picture, you could see in the 2000s, even these left of center governments tend to have budgetary surpluses. You have the 2008 crisis, and you get a countercyclical response, as we're familiar with for many governments within Latin America. Oftentimes in crises, the response has been pro-cyclical. So it's a positive development that we see these countercyclical policies, but you see these blue, right, long sort of blue figures here, once again indicating the growth in Chinese financing. Even though you have that countercyclical response, you can see here that the budget deficits don't go away. There's not that same, if you're having more of your financing come from these policy bank loans, the argument would be is China has less policy conditionality, less scrutiny of macro policy, so countries have more room to maneuver, right? You also have a null case, right? In the case of Brazil, for example, a lot of this financing, even though Brazil has loans to China, it's running through private procurement, right? It's running through those bidding systems. And so as a result, you don't have this correlation with fiscal deficits in the same way. Obviously, there's a lot going on, right? In the case of Brazil, I would argue because much of your financing is coming from market, bonds, right? Private sector, that's going to give more of a pressure to kind of have this budgetary surplus. We see this played out, or at least budget discipline. We've seen this play out with the constitutional spending cap in the case of Brazil over time, but they would fit much more of a null case. So I mentioned before, conceptually, this notion of commercial conditionality. I want to expand on this notion of commercial conditionality a bit more, right? So far I've made the argument that compared to private capital that can be short-term and prone to outflows that create higher interest rates and austerity pressures, I'm making the argument that Chinese financing, by having a long-term horizon, tends to be correlated with more room to maneuver as measured by higher budget deficits. But there's this trade-off. Instead of being policy conditionality, what you lack in policy conditionality, I'm making the argument that you get in commercial conditionality. So this commercial conditionality conceptually has two elements to it. First, there are tools for promoting Chinese commerce, right? This is the bilateral tied aid, Chinese foreign content that was mentioned before, right? If you're going to finance, right, infrastructure internationally with Chinese loans, well, you're going to tie it to Chinese machinery, right? Chinese turbines, Chinese locomotives. But you still also are going to get, because this is commerce to some extent, commercial interest rates, right? So China, with its subsidy, is able, right, implicit subsidy, is able to kind of, even if their market rates go in lower than everybody else, right? I've talked to lots of people from planning ministries, lots of people on the Latin American side that have highlighted, right, when there's public bidding, China has a tendency to be able to come in at lower interest rates than others. There's also this commercial conditionality that reflects currency promotion, right? The extent to which China wants the renminbi to be a reserve currency as they set up sort of all this Chinese commerce internationally. The idea is increasingly, if you can have banks that are in country and able and willing to settle in renminbi, that can also promote renminbi internationalization over time. So that first bucket is all in terms of promoting Chinese commerce, where, again, China is willing to subsidize cheap lending with the idea of promoting markets, maximizing markets over time. But I also make an argument in terms of sovereign risk that China has a different approach to sovereign risk, right? Where compared to the policy conditionality that Western banks will use and the focus on macroeconomics, China is much more likely to have a microeconomic focus. So what do they do in order to mitigate risk with loans? Administrative channels, right? So in the case of those environmental stays in Argentina, what happened? China had lots of correspondence, right, to Macri, highlighting, right, well, if you don't proceed with those infrastructure projects in the South, we have a cross-default clause, right? We'll enact that cross-default clause, and then we'll pull our financing on other projects, right? So they can use administrative channels to ensure, right, that projects move forward. But they can also use commodity guarantees, such as commodity-backed loans. In this case, right, you have a loan outstanding to countries like Ecuador and Venezuela, but you have a simultaneous commercial contract that sends oil exports to Chinese importers. There's then a bank account that takes those proceeds, puts it in a bank account, and it's used to pay down these loans. Why is that important? Well, it mitigates risk because it's tied to this collateral, this underlying commercial contract, but also the terms of those bank accounts allow China to say, well, that money is only used to repay China, right? So it sort of protects the proceeds for repayment in that way as well. And you also have state-backed commercial insurance from folks like Sinosure that is also oriented towards mitigating sovereign risk. So conceptually, those are some key differences. Here's an example, right, of the contracts in terms of the cross-default clause in the case of Argentina, right? And this is something we'll often see. Again, it's not necessarily a Chinese construct, right? We can see cross-default clauses in bond contracts and other places, but it's a tool that China uses on a sovereign basis much more than other official creditors, right? And so it's one of the tools in their toolkit to mitigate this risk. Now, part of my argument then is, even though you lack policy conditionality, you're going to get more commercial conditionality, right? And I've labeled one for the commercial conditions that are promoting Chinese contracts, machinery, things along these lines. But I put a two that would indicate commodity-backed loans, resources, collateral in terms of commodities, things along these lines. And the difference is that you get commercial conditionality either way, but you could see when you have state-to-state loans, which are in the gray, you get a lot more of this number two type commodity-backed loans that are oriented towards mitigating risk, right? And so that's an example of how this commercial conditionality is not only oriented towards promoting Chinese commerce, but also mitigating risk through commodities, through collateral and resources. You can also see this in this correlation here, which is a basic correlation, as China's state-to-state financing grows as a share of total financing, we tend to get more and more commercial conditions as well. So essentially, there's a trade-off, right? You get less policy conditionality, perhaps more room to maneuver, but greater commercial conditions. So in the final, we have about 5 minutes remaining here before we open it up for questions, et cetera. In these final few minutes, I want to just quickly highlight some of the benefits and costs. From a benefit perspective, right? Because as borrowers that need to finance internationally, as governments within the Americas look to China, look to the United States, right? Assessing these costs and benefits could be key. So we know, right, this long-term financing can align really well, as I opened talking about, with the region's development horizon. Also, the fact that you can address infrastructure deficits can be quite good, right? Latin American investment was a mere 0.6% of GDP in the 2000s compared to 3% rates in the 1980s, right? So effectively, the era of austerity, what was sort of one of the, negative byproducts of that era was big infrastructure deficits, right? So not only do we get cheap long-term financing, but it's oriented towards infrastructure, right? That can be beneficial to Latin American countries that need infrastructure. But there are costs, right? And the way this was often talked about met with many different officials throughout Latin America, from finance ministries, planning ministries, et cetera. And this is often talked about in terms of fine print in the contract, right? Like, beware of the fine print. And this is the commercial conditionality, right? That loans are tied to Chinese firms, products, and machinery. And very similar to trade, as I mentioned earlier, Latin America has to negotiate its share of local content, right? So a good example in the case of Argentina, right? You have effectively, an early, windmill industry within Mendoza, right? Early wind power industry that's been trying to be formulated, right? In the case of some of this local content, China's going to be trying to maximize its own content coming in. But Argentina should also have this goal of trying to maximize where it can its local commercial opportunities. Another example is with railway. Argentina has a local industry in constructing railway ties, right? So promoting that industry is key within sort of these negotiations with China. So I think that's a sort of the hidden print. This fine print really reflects this local content negotiation that's really quite similar to trade deals. Why is this important? Well, for reasons like the middle income trap, right? Everybody's trying to avoid the middle income trap through industrial upgrading. But we see, right, the extent to which, China is trying to extract commodities or provide guarantees for loans with access to commodities, right? That's increasing demand for commodities. But what's happening, Latin America is also importing, right, a lot of Chinese capital inputs, right? I've been mentioning turbines and railway, machinery. Now that can kind of undercut sort of local industry within Latin America. So that's very important. Now, China understands this and oftentimes diplomatically talks about complementarities, talks about boosting FDI. And we've seen a boost in places like Brazil, and particularly large markets like Brazil. But of course, right, Brazil is accounting for much of that FDI today, right? So there's still this question of how to spread more and more FDI out and around the region. And also trying to think about, okay, with this commercial conditionality, how can we simultaneously promote, right, local industry, right? So it's cheap financing is sort of the carrot, but you got to be careful, right, in terms of this local content. And then finally, indebtedness is really key as well, that, you don't have policy conditionality, but we've seen, right, still expansion of state balance sheets in the case of Venezuela, where you don't, this could be fine if you have productive investments, but we've seen countries like Venezuela not always have productive investments, which has contributed to indebtedness problems, right? So of course, China is not the only one to contribute to Venezuela's indebtedness problems. A lot of that money has also come from Wall Street, but it's part of the broader issue, right? And there's a question of to what extent is China intensifying long-term trends in terms of debt and dependency. So just very quickly, I can kind of flag some of these patterns we see in Latin America's high-tech manufacturing imports over time. You see a growth, right? This dark black line is a growth in high-tech manufacturing imports from China, right? Many Latin American countries want to promote, right, their own tech industry, right? Like unicorns, et cetera, in Argentina and elsewhere. But we're seeing big sort of increase in high-tech manufacturing imports from China. Similarly, right, we still get big demand for primary commodity exports to China, right? So it's how to rebalance that relationship is one of the key underlying themes here. And also this cost in terms of indebtedness, I can get into more detail, but you can see here just to kind of show you some stylized facts from the Venezuelan case. China's the red here, and that accounts for about 20% of their overall amounts outstanding of debt in 2018. Certainly you see, right, government bonds that are invested in by Wall Street and others still accounting for a good portion of that. But it is showing, right, in terms of Venezuela's indebtedness, China's part of that issue. China's realized this too and has, as I mentioned before, not extended any new loans to Venezuela, but it still has these outstanding loans that are contributing to some of these issues. But the key is, right, in terms of risk, we often hear of a debt trap, right? DC policymakers love to talk about a debt trap. What I'm arguing is often in the case of China, a rising creditor, there's more of a creditor trap, right? Where in a place like Venezuela, where you haven't had productive investment, right? China is basically collateralizing, securitizing that investment through commodities. But look what's happened with things like oil production in a place like Venezuela. As it's dropped off, the red is sort of China's outstanding, or Venezuela's outstanding commitments of oil to China. We see that China, right, that amount outstanding is accounting for a larger share, right, of overall production, but also that overall production is dropping quite vigorously, right? And so this kind of highlights, even though China's trying to mitigate risk with these collateral guarantees, oil for loan deals, resource guarantees, it's still risky, right? Now, of course, you could have productive investments too. In this case, this is just highlighting when, right, the risk may go awry. So finally, it's important to note that China is also taking a diversified strategy. It's aware of the risk of these state-to-state deals. So we see increasingly China's using equity rather than debt financing. They're diversifying exposure away from the sovereign government level to the firm level. So we see more and more state-backed equity funds that have been developed since 2014, where we've had sort of a commodity downturn, and increasingly they're looking for opportunities directly on the corporate level rather than the state-to-state debt level. There's also, since President Xi's 2019 speech at the BRI Forum, an increased commitment to multilateralism, doing joint projects with the World Bank or the Inter-American Development Bank, having AIB head more projects, right? And so there's more and more of a shift towards multilateralism as a result moving forward. So I leave you with the following quote from John Maynard Keynes, highlighting the risk, right, essentially of outstanding loans and having these state-to-state loans from China to Latin America. It may give Latin America more degrees of maneuverability, but at the same time, right, China's exposure, as we've seen, can also create lots of restructuring and lots of kind of restructuring of loans to try to recover outstanding oil collateral, try to recover outstanding payments. So the old saying holds, owe your banker 1,000 pounds, and you are at his mercy or her mercy, owe him or her 1 million pounds, and the position is reversed. So thank you very much, everybody, and I look forward to your comments and questions.
Okay, thank you. Thank you very much for keeping the time, and thank you very much for your interesting presentation, Stephen. We have a couple of questions, and thank you very much, Alicia and Natalia Islas. While we receive some additional questions, and I have the microphone, I would like to I would like to ask you 2 or 3 things, Stephen. No, so if we concentrate the question regarding how patient is or what are the limitations, no, regarding the risk appetite of China's development banks, no? Which issues would you highlight based on your analysis, no? And the second question, Stephen, from my side would be the following. Of course, we all speak of the relationship of Latin America and China. Based on the work we have been doing at the academic network of Latin America, what we have found out is that while, of course, it makes sense to speak of Latin America, there are huge differences between big economies such as Colombia and Mexico on the one hand, and Argentina and Brazil on the others. And particularly Mexico does not make any use of China's financing, no? And this is a relevant point because otherwise we think all Latin America gets financing from China, and this is absolutely not the case. When we, based on the work we've been doing, the financing of China and Mexico is close to zero, no? But again, maybe you can give us your first opinions, and we are receiving some additional questions. Please, Stefan.
Excellent. Thank you very much, Enrique. These are terrific questions. And thank you for your center's work as well on FDI and the monitors. I think that those are very key for those of us following China-Latin America relations. It's a key resource, as I mentioned previously. So thank you for that product. So in terms of the first question, right, where you're highlighting, okay, the capital's patient, but it doesn't have unlimited patience. Where's the key inflection points? So I think this is a nice opportunity to talk about one inflection point that I think is probably the major inflection point, and that's domestically what's happening in China and what's happening in the financial system within China. The extent to which we've seen, right, sources of stress domestically within China, it's very key for what these policy banks do. Why? Well, essentially, these policy banks are funded by commercial banks within China. Commercial banks within China buy bonds from these development banks, and that's a key source of financing for these development banks. And it's very cheap, right? The extent to which banks have to reallocate resources to their domestic balance sheets, that also creates kind of a key source of tension in terms of what they might do internationally, right? So the international portfolio is going to be key ultimately for these development banks. But the important point is their financing, right, may be more oriented towards domestic issues, right? Or the funding source coming from commercial banks might mean that, okay, while before they had very cheap financing that to some extent was unlimited, right? Now that's confronting greater limitations domestically. So what does that mean? Internationally, there's a bit more risk aversion. So does that mean state-to-state financing goes away? No. I think it's still used to break into new markets. It's really, really effective in market maximization, helping break into new markets. We even see loans to Argentina and the nuclear power sector, because this is a key strategic sector for China that it wants to increase. So we still see it there, for example. That being said, they're also likely, as I mentioned before, to use more tools multilaterally or sort of state-backed equity funds that directly invest in corporations because the price tag is far lower than these big state-to-state debt deals. So that's one important point. The second point in terms of variation in Latin America, this is crucial. The way I've set up my book is to exploit the variation in Latin America, because certainly cases of Mexico, Colombia, there's far less of this kind of Chinese financing come in. What I'm looking at within the book on a case level are the major debtors historically, right? With the most outstanding loans, the Argentinas, the Brazils, the Ecuadors, the Venezuela, increasingly Bolivia, even places like Costa Rica, Jamaica, but trying to really look at what that variation looks like. And undoubtedly, right, I think in the case of a Mexico, for example, as you're highlighting, there's not that same need or dependence upon Chinese financing, and maybe even more wariness for some of the fine print I'm talking about that might undercut local industry, right? Because Mexico is going to be competing, right, with China in some of these industries, particularly and Asia relative to the United States, right? That they sort of want to protect that economic relationship with the United States as well, right? So I think those dynamics make Mexico different from other countries. And I think there's even variation, as I mentioned, between a Brazil and Argentina, depending upon where that financing is going.
Okay, thank you very much, Stephen. There are a group of questions by Alicia and Natalia Islas. I don't know if you can see them. They are very detailed and specific, no? She starts asking about if something has changed since the COVID, since the pandemic, regarding buying debt by Chinese banks, no? And if it is useful, the Chinese banks would buy Latin America's or very concretely Mexico's debt. Would you see there's something positive?
I think so. We've seen a bit of a shift, I think, since the pandemic, right? It's aligned with sort of you had a commodity downturn, then you have the COVID shock. So those are sort of shocks that have caused China to recalibrate some of these risks, right? So I think that diversification strategy is a product not only of the commodity downturn, but we've also seen less state-to-state lending coming into the region with the pandemic shock, right? What did we see instead? Well, we saw sort of a different emphasis, right, through the pandemic, where we saw much more vaccine diplomacy, right? Health diplomacy oriented towards sort of building state-to-state relations, but much more via health diplomacy and things along these lines. We still see, I think, in key sectors like telecommunications, that there are these important, tied loans. There are these sort of, loans that are oriented toward expanding market share that still happen. But I think they're becoming more and more targeted, right? So the extent to which we see them, and see Chinese loans headed to Latin America, it tends to be in telecommunications, renewables, much more kind of key strategic sectors. So I think that's a really key element. But certainly even talking with Chinese bankers over time as well, if you think of uncertainty in the world and how that's affected economic decisions, right? You've had COVID, you've also had the US-China trade war, and that effectively, even among Chinese bankers, has made them more cautious, right? And I think that's one of the reasons you see more of a focus on these state-backed equity funds, right? Can we invest directly in a corporation for a lower price tag of, say, capping at 100 million, as opposed to several $1 billion on a state-to-state level? It also kind of keeps it out of the headlines, right? When you're doing kind of more of these targeted state-backed equity fund deals, and U.S.-China trade war and tensions is a big issue, kind of allows you to fly a bit more under the radar as well, right? So I think that those are some key features that we've seen in terms of changes since the pandemic. But that being said, I still underscore the idea that state-to-state loans remains an important part of the toolkit that China will use when it wants to break into key markets.
Going back again to the questions, Stephen, Alicia also asks if you know of cases of China buying Mexico's public debt, no? And if there are any kind of limitations based on the trade agreements between the US, Canada, and Mexico. Do you have some information or analysis there?
Sure. So I should start with the disclaimer. I'm not a Mexican expert, right? So my cases within my book tend to be more South American oriented. So I'd start with that disclaimer. I have not seen, or I've not heard of direct Chinese purchases of Mexican bonds necessarily. That's not to say, right, it may be happening in a more decentralized fashion, but I haven't heard much of that. And I know with the renegotiation of NAFTA, et cetera, I think there are important limitations in terms of, what Mexico can do in terms of its financing, right? I think there is some fine print within the NAFTA deals that might mitigate some of that access as well. More broadly, what I can say is that China has had a record in other countries of buying their bonds. I think one country that stands out is Costa Rica. When they first opened the spigots of Chinese financing, China built a stadium, right, a well-known prestige project in exchange, right, for that, agreeing to recognize the One China policy and opening up. But, right, simultaneously, there was also the direct Chinese financing of Costa Rican bonds. Why was that important? Well, it was right during the 2008-2009 financial crisis, where, right, Costa Rica was getting squeezed, and a lot of money was flowing out of key sectors, including tech sectors, right? So the fact that China stepped in and was willing to finance about 1% of GDP of bonds of Costa Rica, they provided some key financing, right, during a cyclical downturn for Costa Rica. So certainly there's been precedent in other countries, but I haven't heard any word of China doing that with Mexico recently. If anything, I'm under the impression from sort of the NAFTA deal that there are some restrictions, even in the way that, Mexico would be able to access some of this financing, right? Particularly in terms of some of the underlying content agreements with NAFTA would mitigate, right, promises of all this Chinese content in the way I understand it, right?
Well, thank you very much. Congratulations also by Patrick Leeds and Susanna Nudelsman that you know. And two very different questions. One from Alicia. Do you know how, or could you give us your opinion or analysis regarding the United States debt, which has been bought by China, and more recent dynamics in this on this topic? And then the question by Patrick Leeds regarding options within Latin America in integrating versus China, no? And Patrick Leach speaks here specifically of the lithium market in which Bolivia and Mexico might be working together vis-a-vis China, although they have little technology and other benefits, no?
Sure. So if I understand the first question correctly, it's in terms of U.S. sovereign debt and how the U.S. finances itself. Certainly, this is an issue because what we've seen, if you look at the financing structure of the United States over time, it's become oriented more towards short-term debt, right? So, I think, maybe it's 30, I think about a third of it, if I remember correctly, might be short-term debt. Also, increasingly, the United States has become more reliant upon foreign debt, foreign financing of its debt. So certainly, China, historically, with its big reserve accumulation, has been a big investor in U.S. Treasury. It's one of these things where, notwithstanding all the rhetoric, right, there are a certain amount of interdependence between China and the United States that goes forward. This financing of U.S. Treasury bonds is one of them, right? But there's lots of still high levels of economic interdependence between the two countries. Does that maybe set up potential for down the road, right, of critical coercive diplomacy one way or another? Sure, but I don't think it's in either country's interest, right, to basically take things to that extent, right? Because I think that would undermine the economy, not only the United States, but also China, right? So it's sort of a very interdependent relationship that is still very sensitive in that way. I think comparatively, then there's also this question about lithium, right? And I think this is key, right? Because this is an area too, what we often hear, right, I think within Latin America and talking with people from South American governments is, well, we don't have the same capacity necessarily as China. So how do we compete? How do we preserve local content and things like this? Well, I think having key, resources like lithium that the whole world wants gives Latin America some leverage, right? And the reasons for Latin America to try to collaborate across countries to try to, expand that leverage relative to other countries. I think from the other side of it, certainly, right, China lacks some of this technology and sophistication and know-how. That, I think, relatively is then the comparative advantage of sort of Western countries in the United States, where they can market that relatively, right? So maybe you don't have the cheap financing, that large-scale financing to bring to these issues, to bring to bear on these issues in the same way, but you have this technological know-how. And I think we see increasingly, right, even the United States is shifting its diplomacy more oriented to South America to some extent because of concerns about lithium and sourcing lithium, right? So I think that this is a great leverage point for Latin America moving forward, where Latin America could really use the desire for these key resources to link to other issues and boost its negotiating power across other issues.
And two additional and final questions, Stefan, regarding China. What is China's debtors' attitude? Well, it should be creditors, if I understand correctly, from Wei Chou. What is Chinese creditors' attitude to our labor unions? No, I don't know if you have done something on this. And Patrick Lee asks if you see any parallels between the British Empire investments with the Chinese ones. Is there any kind of comparison? And this is related a little bit to your reflection a moment ago, no, with the US probably. But
sure, yeah. So this is terrific in terms of the first question. In terms of debtor attitude towards labor, I think China's come a long way, right? I mean, one thing that's missed when thinking about Chinese creditors is they learn over time, right? Sometimes China's and their policy banks are treated as monoliths, right? But I think labor is one issue that we've definitely seen Chinese creditors change on, right? So I think of some of the early negotiations between China and Brazil, right? China wanted to bring a lot of labor, right, for pipelines and other things within Brazil, and Brazil balked, right? And we see sort of as the new renditions of Chinese financing coming to a place like Brazil, we see more acknowledgement, right, of the desire for Latin America to use local labor, right? And so increasingly, we even see President Xi travel to Brazil. He's talking about local jobs, right? And Chinese financing expanding and investment expanding local jobs. So I certainly think, and then from the other side of it too, when you think of how Latin America negotiates with China, right? I mentioned local content. One area that's clear that Latin America negotiates very strongly on is labor, right? And manual labor, particularly for the civil works projects. I've spoken with labor ministers, economic ministers who basically have highlighted, one labor minister in Argentina, for example, highlighting, hey, if we didn't preserve jobs, right, people would be extremely upset, right? I would potentially lose my job, right, as a result of this, right? So this is something that, was really key to negotiate on. So certainly, I think that there is a high priority in terms of labor and unions that Latin America has in preserving manual labor jobs. But I also think China has become more savvy to this as well. Then there's sort of the last question in terms of empires, right? The extent to which, right, British Empire had a history within Latin America. How does China compare to that? Well, I think one important area is that there are potentially more complementarities, right? So we hear complementarities diplomatically, but given that China wants to invest in infrastructure, there's been these infrastructure deficits with Latin America. That's one area where there is a real complementarity, right? We haven't seen Western private sector, right, willingness to invest in large-scale infrastructure. And even official creditors haven't been willing to do that in the same scale as China for quite a while, right? So there are these complementarities that are, reminiscent of Britain's willingness to invest in railway and infrastructure and things along these lines. I think there's also potential complementarities in the sense of, well, the United States, particularly from a trade standpoint, is trying to protect agriculture, right? So then when you have big agricultural producers like Argentina, Brazil, there's potential friction there, right? I think comparatively, right, there's less friction in that area with China, right? China's more willing to purchase large amounts of soybeans and agriculture in exchange for other goods, more willing to invest in agriculture, right? So there are these complementarities that are different from the relationship of the United States over time that I think are important.
And two last questions, and we finish, Stephen, because this can go on forever.
I'll stay here all night.
But by Andrea Salazar, how would you compare, or what would you say? What is your opinion on the Build Back Better for the world to the Belt and Road Initiative? Do you have some thoughts on this? And the final question, again by Patrick Leeds, if you have looked at the impacts of U.S. sanctions that have conditioned the Venezuelan economy. No?
Excellent, sure. So the first one, Build Back Better. And following this issue, it was good to see the emergence of Build Back Better, right? Because I think in the early days of Chinese investment and financing in Latin America, rhetorically, the United States oftentimes took this position of, oh, well, you shouldn't, move forward with this financing. You shouldn't necessarily move forward with this investment, right? Particularly in the shift in posture we saw during the Trump administration. But ultimately, right, from the Latin America perspective, from a region that needs financing and capital, why wouldn't you take this opportunity, right? So I think that, seeing the emergence of something like Build Back Better is a more savvy approach, right, to this issue, where you're trying to offer Latin America something from a development standpoint and incentivize U.S. corporations to invest in Latin America, right? Because Latin America wants U.S. investment, right? And they'd be happy to see more U.S. investment in Latin America. So I think that Build Back Better is sort of saying, oh, well, okay, we see there's a huge scale of financing from China dedicated to Latin America. How can we better compete? And we see with Build Back Better and Development Finance Corporation, more sort of equity and financing of equity dedicated to projects in the region to help encourage, greater investment. And I think this also comes back to the issue of how do you compete? Well, if not with scale, maybe with expertise, right? And so, not only having these incentives for firms from the West to invest in Latin America, but also being able to feature their comparative advantage in technology. That also is kind of a key issue here, or in transparency and due diligence and all these other issues, right? I think that that's really key. And so it's good to see those kind of measures coming out of the United States. I think in a lot of ways, there needs to be more of that. And I think the extent to which the US is looking to reorient supply chains, right? And, reduce its dependency on Asian supply chains. I think there's a lot of growth potentials for both United States and Latin America by looking to the South. Then in terms of the second question, which was the Venezuelan economy, it's really interesting, right? We see China often really mitigating political risk often in these deals, right? So what we see in Venezuela is often China's been on the sidelines, right? Trying to maintain a middle ground and promote its commercial opportunities in the long run in the energy sector. So when we've seen sanctions by the US of Venezuela, often China's been in compliance with it, right? What we have seen, and I mentioned this in a report I did for the Wilson Center that I'm happy to also make available to the center as well. But it's a chapter dedicated to Venezuela, and the sanctions are a part of that. But one thing that was found is that before there were secondary sanctions, right? There was many kind of Indian companies that were buying oil, right? And then reselling them to many different buyers, right? And we would see sometimes China would be buying from those intermediaries still, but they were careful to comply with US sanctions. And once US moved to secondary sanctions, we still see China very careful to comply, right? And I think we see a similar thing to some extent with Ukraine, where if there are economic sanctions, China's going to comply. It's going to protect that commerce in the long run, and it's going to try to stay out of the political fray, right? Try to keep that intermediate position in hopes of expanding market share over the long run.
Okay, Stephen, thank you so much for your time. We are very grateful, and we will look deeper into your book. I can only invite everybody to buy the book, to read the book. No, I think it is really worth it. I hope we can keep in touch and exchange opinions, based also on the research the academic network in Cechimex is doing on these issues, and so that we are in touch of our respective work. No?
Yeah, that sounds terrific. I look forward to future collaboration. And I must say, too, I've done a fair amount of these Zoom meetings over time, but I'm really impressed with the quality of the questions and knowledge of the audience. It was a great fun to present and hear your perspectives. So thank you.
Thank you, Stephen. We will be in touch, and have a good morning. And
thank you very much. And have a good night, right?
Exactly.
Thank you very much, everybody.
Hasta luego. Goodbye. Thank you.
Hasta luego. Muchas gracias.